morning and welcome. This is Business Morning on Channels Television. Thank you for joining us. I'm Chimeze Obi Iwagu. The National Bureau of Statistics just released the February inflation numbers, and it shows inflation increased to 12.20% year-on-year in February 2020. This is 0.07% points higher than the rate recorded in January, which was at 12.13%. Increases were recorded in all divisions that yielded the headline index. On month-on-month basis, the headline index increased to 0.79% in February. This is 0.08% rate lower than the rate recorded in January, which was 0.87%. The urban inflation rate increased by 12.85% year-on-year in February from 12.78% recorded in January, while the rural inflation rate increased to 11.61% in February from 11.54% in January. The composite food index rose to 14.90% in February compared to 14.85% in January. Now, the average annual rate of change of the food sub-index for the 12-month period ending February 2020 over the previous 12-month average was 13.98%. That's 0.12% points from the average annual rate of change recorded in January. Now, this rise in the food index was caused by increases in prices of bread and cereals, fish, meat, vegetables, and oil and fats. On month-on-month basis, the food index increased by 0.87% in February, down by 0.12% points from 0.99% recorded in January 2020. In the meantime, the Central Bank of Nigeria yesterday announced 6 initial policy responses to combat the COVID-19 impact on the economy. The measures are extension of moratorium. All CBN intervention facilities are hereby granted a further moratorium of 1 year on all principal repayments effective March 1. This means that any intervention loan currently under moratorium are hereby granted additional period of 1 year. Accordingly, participating financial institutions are hereby directed to provide new amortization schedules for all beneficiaries. And then we have the interest rate reduction there. Interest rates on all applicable CBN intervention facilities are hereby reduced from 9 to 5% per annum for 1 year effective March 1. Creation of a 50 billion naira targeted credit facility. The CBN is establishing a facility through the Nassel Microfinance Bank for households and small and medium-sized enterprises that have been particularly hard hit by COVID-19, including but not limited to hoteliers, airline service providers, healthcare merchants, and so on. We also have their credit support for healthcare industry. This is to meet potential increase in demand for healthcare services and products. The CBN it's open for its intervention facilities loans to pharmaceutical companies intending to expand or open their drug manufacturing plants in Nigeria, as well as to hospital and healthcare practitioners who intend to expand or build the health facilities to first-class centers. This is in addition to growing the size of existing interventions to the agricultural and manufacturing sectors in Nigeria. There's also the regulatory forbearance, where the CBN is granting all deposit money banks leave to consider temporary and time-limited restructuring of the tenure and loan terms for businesses and households most affected by the outbreak of COVID-19, particularly oil and gas, agriculture and manufacturing. The CBN would work closely with deposits money banks to ensure that the use of this forbearance is targeted, transparent and temporary, whilst maintaining individual deposit money banks' financial strength and overall financial stability of the system. There is also strengthening of the CBN LDR policy. In view of the success of the LDR policy in growing credit to the economy and reducing interest rates, the CBN will further support industry funding levels to maintain deposit money banks' capacity to direct credit to individuals, households and businesses. The CBN will also consider additional incentives to encourage extension of longer tenured credit facilities. Deposit money banks are encouraged to continue to build capital buffers in order to improve resilience of the sector. And of course, the central bank says it stands ready to provide liquidity backstops as and when required in view of its role as banker of the federal government and lender of last resort. It says it will continue to monitor developments and will issue further updates as may be appropriate. Okay, let's talk to Johnson Chukwu, the CEO, Cowrie Asset Management, for his first words on these developments. Good morning, Mr. Chukwu. Thank you for joining us.
Good morning, Timothy, and thank you for having me.
Well, first, let's get your reaction to the inflation numbers just released this morning, 12.20% from 12.13%. Was this in line with your expectations?
Absolutely. I was expecting that the inflation rate would increase further in February, which is actually what has happened. But interestingly, the rate of increment was actually not as steep as one had expected. We saw an increase of just 0.07% from 12.13% to 12.20%. So one would say that increase was actually moderate. But when you now look at the components, what is driving that increase, and that's where the concerns will come from. If you look at the food inflation index increased to 14.90%. But when you want to look at the core inflation, which is food inflation excluding the volatile items, you're down to inflation rate of 9.43%, which means the increment we are seeing in inflation is being driven by food prices. And that has persisted August last year when the borders were closed. And fortunately, we are gradually moving away from the harvest to the planting season. So it's expected that the pressure that flows from food inflation will actually worsen in coming months as we move into the harvest season, because the major pressure we're getting is coming from food inflation. And added to that is that you just had an increase in VAT, which has not reflected in the price, general price level as at the time the data for February inflation was taken. So by the end of March, you are going to see some further adjustment in consumer price level as a result of the increase in VAT, value added tax from 5% to 7.5%.
All right, just as you said, the difference in the increase is not much, notwithstanding the rise in inflation. Yeah, we see that the rate of increase, of course, is declining. Does that suggest that the base year effect is waning?
That will begin to manifest when we get to the month of August, when we saw the steep increase in, when we began to see the current increase, constant increase in consumer price level. The base effect will begin coming into effect, like I said, from August. And that was in August that we saw the first increase in inflation rate. But the basic thing that has happened is that because of low consumer demand, so the rate at which prices increased the month of February was not as steep as it was in January. Again, like I mentioned, the pressure that started with December and January was not there in February. And we are still living at the peak of the harvest. And last year we had a very good harvest because of good health. So when we go into the farming season or the planting season, because we don't have storage facilities, the volume of food items will decline, and that will manifest in higher level of food inflation in the coming months, added to the pressure that will come from the general increase in value added.
All right, now, one factor that perhaps may be attributed to this inflation number is the COVID-19 pandemic. Yesterday, the central bank reeled out about 6 measures to curb the effect of COVID-19. What is your take on these measures by the central bank? Have they come at the right time, and are they enough?
Well, they are coming at the right time. I'm quite happy that the central bank saw the need to come up with specific response to COVID-19 in this country. I mean, other countries have been responding. This is the first articulated and well thought out, or what we call the first policy response as it relates to how do we model the impact of COVID-19 on Nigerians. Other countries have responded in several ways. We saw the U.S. Federal Reserve Bank cut rates to 0.1%, 0.25 to 0.00. And they also came up with an announcement they're going to go on quantitative easing about $70 billion to buy assets so as to reduce the interest rate in the economy. We've seen political initiative of several governments. Governments are shutting down their borders. I've not heard any border shutdown in the country. Countries are restricting travel from countries that are heavily affected. I've not heard any of that in the country. So this is the first well-informed, well-thought-out response. Granted, it's focused on economic issues. I hope that the fiscal authorities will also come up with additional responses, because in as much as the central bank has come up with these 6 items, one, to grant interest rate principal repayment for moratorium on intervention funds granted by the central bank, to reduce the interest rates on intervention funds from 9% to 5%, to set up a 50 billion naira intervention fund to support the healthcare sector, pharmaceutical industries that want to set up in the country, healthcare institutions that want to scale up and provide some services in managing the COVID-19. They also came to announce that the banks should grant some level of, they will grant some level of regulatory forbearance to banks, so as to allow the banks grant some accommodation to their borrowers, because we all know that businesses are suffering with this COVID-19 crisis. Economic activities are slowing down. In other countries, we're actually seeing complete shutdown of cities, towns, restriction of movement. We have not gotten to that extent in the country, because luckily for us, we've not seen severe effects of the COVID in Nigeria.
Okay, Mr. Chukwu, just a quick one. Now, interest rates on all applicable CBN intervention facilities, of course, have been reduced from 9% to 5%. But the question many have asked is, what about the deposit money banks whose interest rates are high up? Now, the Central Bank Monetary Policy Committee will be meeting next week. Do you see them doing anything or tinkering with the interest rate by next week?
Well, that will be difficult for the central bank, because the monetary policy authorities have to look at several factors in deciding on what direction of interest policy to follow. Today, we are seeing a lot of pressure on the FX market. We are seeing depletion of foreign reserves. We are seeing the exit of foreign portfolio investors. What I rather think the central bank will do, the monetary policy authorities will do, is to increase interest rates on fixed income instruments, such as the treasury bills, and obviously allow private sector investors to come back into the normal market. If you look at the yield on the normal segment of that fixed income instrument, you'll see yield that effectively about close to 20% today. And the key thing that should be applied to the central bank today is, how do we ensure exchange rate stability in the face of dwindling foreign exchange earnings? And one of the tools available to it is to use the interest rate tool to increase rates. I don't see the central bank reducing rates. What they could have is some level of intervention, like they say, they're granting regulatory forbearance to the banks, so that what they want the banks to do is that in the event that customers are unable to pay back their loans as at when due, they are not going to compel the banks to provision those such loans to adhere to the prudential guidelines on provisions for non-payment of interest and principal amounts. So, and that way, these banks will allow the customer to ride through these difficult periods. But as to ask the banks to reduce rates, I don't think the central bank can afford a further rate reduction at the point when we are going through severe pressure on our foreign reserves.
All right, thank you very much, Mr. Chukwu. Let's wait and see what happens eventually next week. Thank you for your time. Mr. Johnson Chukwu is the CEO of Carry Assets Management Company. All right, let's take a quick listen to the Central Bank Governor, Godwin Emefiele.
You probably already know that thousands of people, hundreds of thousands of people are affected by this pandemic, and indeed thousands of people have died. And in different parts of the world, leaders in those countries, Fed chairs or the governors of central banks in those countries have all started to respond as to what actions would they be taking to mitigate the pains that will be visited on their people as a result of the outbreak of this coronavirus pandemic. You know, from the monetary side, For instance, in the United States, there has been reactions from the J-Power twice in 2 weeks about interest rates. Even the President Trump himself had talked about how even loans to students in universities and schools will now be offered, at least during this interim period, at zero cost and all that. Several things are being done by different economies, particularly on the monetary side, to see how to ameliorate the pain on the people of those countries. But let me say that our initial assessment shows that the consequences, yes, we do expect, naturally we're beginning to see as a result of the death, what we call health crises on people in different economies and different countries.
Godwin Emefiele, the central bank governor. Now let's look at the commodities market space. Let's bring in Desola Sumoni, one of the research analysts with Financial Derivatives Company. Good morning, Desola. Thank you for joining us. We have seen coordinated efforts by central banks to cushion the effect of COVID-19. Just yesterday, the Central Bank of Nigeria announced its stimulus package for Nigeria. How do you see these impacting the domestic commodities market space?
Thank you for that question, Chimizi. First, I think it's positive. I think it's a welcome development. It's proactive of the central bank governor and is in line with the overall coordinated effort by central banks globally. But on the effect on domestic commodities market, I think because the government is the central bank is trying to stimulate consumption, trying to reduce the cost of obtaining funds. I think it's going to increase consumers' demand, which is positive for domestic commodities market. So I think the access to funds and the fact that there are no lockdowns in Nigeria, there are no travel restrictions, people can actually access this funds and actually spend them. So I think that is positive for domestic commodities markets.
Now, February inflation came in at about 12.20%. Now, FDC had projected 12.30%. It's in line with your projections. But would you say it's all about COVID-19?
And thank you again for that question. It's not all about COVID-19. I mean, although that also has an effect, but I think the key driver of inflation right now was food prices. We saw food prices increase compared to January. We also saw core inflation, which is headline inflation less seasonalities, also increase. So I think the key driver here is food prices. But the good news here is that the pace of increase is actually slowing down. So it appears that the base year effects are waning already.
Now, food inflation, like you said, of course, remains high. How much did the border closure contribute to this?
I think the border closure contributed partly to food prices because currently while the border closure led to increase in domestic food production, but the growth rate of domestic food production is less than the growth rate of domestic demand, and that's why we see this shortage. And usually that shortage was initially covered by imports, but because there's now a ban on imports, the borders are closed. I think that shortage has now led to food price increases. So I can say that the increase in food prices is partly attributable to border closure because of supply is increasing at a slower pace than demand.
All right, Desola, in 30 seconds, how would all of these feed into the MPC's decision next week?
Thank you again for that question. The MPC is going to consider important factors like inflation. Inflation is now 12.2%, which is higher than the central bank's target rate of 6.9%, and also the exchange rate has depreciated in the parallel market. So these are important considerations that the central bank would consider, and it strengthens the argument for tightening at this time.
All right, thank you very much, Desola, for your time. Desola Sumoni is one of the research analysts with Financial Derivatives Company. When Business Morning returns, we'll talk more on the global coordinated stimulus and the implications for the Nigerian economy. Just stay with us.